On behalf of CrossCheck Media and Biz Talk Today TV, welcome everyone to Buy, Hold, Sell. I am your trader, Todd Schoenberger, and I am joined by my friend and co-host, Tobin Smith, out in what I believe has got to be scorching hot Scottsdale, Arizona.
95 degrees, you idiot, and it rained yesterday.
Listen, it's 85 in New York right now, so things are boiling up, but it's summertime, right? So listen, Toby, you have coined the phrase, the certainty of uncertainty, and we have an expert, a specialist, all about coming up with ideas for alternative investing because there is so much uncertainty. Jillian Murrish, she is the CEO of Pier Asset Management, is joining the show. Welcome to Buy, Hold, Sell, Jillian.
Hi, it's great to be here.
Well, it's great to have you. And Jillian's coming to us from Los Angeles, California. She's in the nucleus of the entertainment district, and we have so much to get to about that. But Jillian, tell the audience a little bit about Pier Asset Management.
So we're based in Los Angeles, as you said, and we are a private credit investment firm focused on niche opportunities in specialty finance.
That sounds rehearsed, Todd. I want to hear the real story.
Well, I've said it so many times, it comes off the cuff like that.
Well, that's great.
Well, listen, I'm a SoCal boy, and I had an office in Century City, which always cracked me up because you'd walk down the street and, I'm wearing a suit. The person worth $500 million has got a T-shirt on and short pants, and, it's a different world. What part of LA is your office?
So we're based in sunny, casual Manhattan Beach. Which is lovely. We escaped the riffraff of Century City and Beverly Hills. But back in my investment banking days, I was one story below the CAA office on Constellation Boulevard.
Constellation, yeah.
And constantly saw the agents going up and down the elevators with clients, and I was the chump in my suit going up and down those elevators.
Oh,
all right, well, I would never call you a chump. I lived in Manhattan Beach, Todd, for many years, and I will just say this: if I could recreate that house I sold for $800,000, that's now worth $8 million, and just have my office right in the front of the deck on the boardwalk, I wouldn't be messing around here. Okay, you know what I'm saying?
There you go. There you go. Well, we love you messing around here. So, Jillian, I have to ask you though. So, from an alternative investing perspective here, and I know your firm focuses on debt. Can you give us an idea, though? What would you recommend? Because with so much uncertainty, you have the markets up and down. You got tariff news every day. Things are moving. We had the jobs report. ADP came out today, was very disappointing, which is going to lead into Friday's jobs report, which is likely going to be negative for as far as what Wall Street is considering. But when you're talking to your investors and you're talking to potential clients, what are you saying to them as far as trying to come up with an idea as far as an alternative investment?
Yeah, so when I look out at this pattern of uncertainty, I say two things: invest in short duration assets and invest in uncorrelated assets. Both things keep you out of trouble. To me, short duration is synonymous with resilience, and then uncorrelated asset classes, you can hide from all the noise, don't have to pay attention to the jobs report, and life is good.
Wait a minute, Brazilians?
Resilience.
Oh, it's kind of like you said Brazilians, and I was going, okay, I'm not going to touch that. But
no, short duration is synonymous with resilience.
Yes, resilience. Okay, thank you.
But to touch on something before we move on, so the jobs report not looking great, right? I think it's an uncertain mixed picture. If you look at most recent unsecured consumer credit data, you actually see that 2024 vintages of consumer credit are actually outperforming 2023 on impairments. Charge-offs dropped to their lowest point in 3 years in April, even lower than pre-COVID levels. So it's a mixed bag, right? So you're getting jobs reports that are bad, but actually consumers are paying their credit card. So really, if we were certain that a recession was coming and we knew that that was certain, there could be ways to invest that could capitalize on that.
Sure.
But because it's not certain and we don't know and the data is still mixed, I think we have to stay short duration and we have to flock to uncorrelated assets.
What's your take on this change in the student loan repayments? We saw this giant spike in the consumer credit. People who have these 20 years to pay off their graduate school, and they're making like $70,000 a year, so they're never going to get out of that. Does that affect your perspective at all? At least when it's dealing with credit for individuals?
Yeah, I mean, if you look at the student data, I mean, there was a huge spike in delinquencies that when loan payers came back online last month.
Yeah.
But if you look at the overall consumer credit market as a whole, it's trillions of dollars, and
Sure.
compare that to the amount of student loans that are outstanding, and it really is a drop in the bucket. Again, it will affect a small swath of these consumers, but overall, I don't think it moves the numbers.
All right, good to hear.
That's good to hear.
I was just amazed at that spike. I mean, first off, they
Yeah.
hadn't been paying before. No, don't even get me started on that. Okay, all right. So,
Well, go ahead.
so
go ahead,
in Manhattan Beach, and your type of, tell us about the type of deal you do. I like the fact that you do music royalties, because I love that stuff. And it's a great business that no human being could really get into unless it was somebody like you.
Yeah. So we're the boring side of music. We're the finance folks, and so over here at Pier, we buy.
None of this.
Over here at Pier, we buy portfolios of songs from either record labels, artists, or anyone else who owns these music rights. We buy them outright, and every time a song gets played, we get paid. And so
You got to work on that alliteration, okay?
I know it's a mouthful, that's for sure.
Yeah.
So when these songs get played on Spotify, YouTube, Apple,
Yeah.
We get paid about 1/10 of a cent or whatever it works out to be. And this music investing has been in the headlines. It's been on the Wall Street Journal. It's been in Bloomberg the last few years, and really these big banner trades have been going through, and they've been getting a lot of attention. So Bruce Springsteen, for example, is one of these.
Which I'm sure you passed on at a 20x, lifetime.
That's right. And so, these catalogs trade at a trailing 12-month on a trailing 12-month multiple. So you look back and see, what did this catalog produce over the last 12 months in terms of revenue, and you apply a multiple to it. These banner deals are trading at something like 20x trailing 12-month revenue, which is, from a financial investor perspective, not a great return over time.
Not a great return.
It's fun to own these, yet it's not where you would invest if you're trying to optimize financial return. And so,
you're talking like Springsteen, Bob Dylan. I saw Joni Mitchell, who I'm a big fan of, is putting her stuff up. How about the thing that gets me that we talked about this week, which was like the producers selling their slice? Does that ever come into your space?
Oh yeah, that's right, all the time. A lot of producers, when a song gets created, the rights to the revenue a song produces get split among various participants. So on day one, the producer gets a cut of the revenue. The guitarist, the singer, the record label, the songwriter, for example. And so all of these participants get a portion of the revenue. And so production companies, producers, as well as record labels, all take a part. And so we often see catalogs being sold from record labels and producers. And an interesting trend that people aren't as aware of, that's not as obvious, are these record labels are small businesses. Many of these independent record labels are small businesses. And as we head into a rockier economy, which looks like that's where we're going, these small businesses will begin to struggle. And when they struggle, they need working capital. And the most obvious way or easiest way for them to attain working capital is actually to sell rights to music that they own. And so they come to groups like us. We're able to buy those catalogs and give them that working capital. So it's a great source of deal flow for us. And we only anticipate it getting busier in that sector.
I bet. So I have a number of books, a few bestsellers, just bragging. The royalty rates. If I had an actual really big blockbuster book and I was getting royalty rates, et cetera, would that also apply to authors, to things outside of music?
There's a whole multiple other content genres we look at. We don't invest in them. Things like YouTube rights, YouTube royalties on short videos, film catalogs. Books, right? And so, there's a whole other market for that. We're not a participant in it, so I can't speak to it intelligently, but we get hit up often for purchase our podcast, rights to the podcast. And, I haven't gotten called from Todd yet, but maybe that's coming.
Well, I'll tell you a quick story. So
the audience understands.
Yeah, you're right. So the audience understands the hierarchy. I'm going to this dinner way up in Holmby Hills, the really super high-end Beverly Hills thing, right? And the driver, we're going like up these circles, and I'd say, well, who lives over here? And it says, here's how it works. The actors are on the first level. The second level of the houses are the directors. The top level, where all the big money is, are the people who write music and get royalties every month. And so it was just amazing to see. If you're not familiar with how royalties work and how royalty drives entertainment industry revenues and so on, it's you. If you're a person watching this, you want to marry the person who's writing great songs or great books, because their royalties are off the chain.
And the beautiful,
okay.
I was gonna say, the beautiful thing about being a songwriter is, yes, you get rights, and these are called publishing rights. It's a specific type of music rights. And the Publishing Association has done a fantastic job of actually increasing the payout to songwriters over time. And that's a trend that we think will continue.
Wow. So what is the average? Spotify pays $1 to run my song. How much do I, as the songwriter, get out of that dollar?
Oh, goodness. Well, so that's a really nuanced answer. Many of the artists are actually the songwriter themselves. And so that gets lumped into the song and into the writer, into the singer share as well.
Yeah.
And then the actual calculation, this is a whole lesson. I'd have to pull up my Excel spreadsheet and screen share here, but the whole lesson to figure out like how much you actually get paid every time a song gets paid is really complex as well. And the best place to go look, which you're well versed in, to figure out how that's looking is actually at the 10K or 10Qs of Spotify and Apple, and go look in their music segments, because it's actually they get paid out a percentage of certain line items of revenue for these different businesses. So it's not.
So now here's the deal.
There's not like a number they get paid per song.
Yeah, I get. So how much are your investors making on these deals and stuff you buy? Because I gather it's more than just a money market account. I mean, this is me. I'm incredibly brilliant.
Well, the goal in investing in alternatives is always to beat the money markets, that's for sure. And so investors in the music space, generally if investors are buying these catalogs at 20x, that would yield some sort of 5% type return.
Yeah, single digit.
Yeah, and so for us, we're much more interested in mid-teens and low 20% yields, and so to do that, we have to be finding catalogs that are trading at 4 to 5 to 6x trailing 12-month multiple, and so to do that, we have to go into smaller catalog sizes with less banner style artists, where we can actually make that investment decision based off the cash flow of the catalog, not the brand name recognition of the artist, and so numbers speak, and that's where we invest.
So how many parties are there though that writes? I mean, for example, Toby, he's strumming his banjo and he's the songwriter. I mean, but there's got to be a producer, there's got to be a distributor. I mean, how many layers are we talking about for that fraction of a penny?
I would say the tightest deal we've seen has 3 owners, rights to a song. The largest we saw the cash flows were split 20 ways. So and then even the songwriting publishing rights can be split amongst a group of songwriters who team together and work on a song. Then there's an artist that comes and does like a sampling on the song. So they come in and provide, some special vocals. They get a piece. I mean, it can really drive up the number of participants.
Okay.
Yeah, Todd. Todd, when you live out in Hollywood, et cetera, and you see all these mansions, to my point, nobody really understands, unless you're really deep into the business, how many fingers are in the pie. But when somebody gets a hit, which is my next question to you, young lady, if somebody gets a big hit and they're a first timer, you're going to get a lot of royalties early now. But what's the strategy in terms of the artist? How long they've been in business? How many songs they have? Blah blah blah.
Yes. So what you're touching on is what we call a degradation curve. So the day a song is released, if it's really popular, you're making this much revenue. So you're making $100 that day. Right. Very quickly, over the first 18 months the song has been released, the revenue you make on that song degrades rapidly. So you're just flying down this degradation curve up until month 18. Whatever revenue a song's making around month 18 to 24, you can look at that and say, hey, that's a sticky song listener base. These are super fans who love this song. They kept it in their permanent album or their permanent library, and they come back to it often. that listenership will be relatively stable for the next 10 to 15 years. So once you get down to 12 months, you can look at that number and have a pretty good idea that revenue is only going to degrade at about 2 to 5% from there on out. And so that's an interesting segment to invest in music royalties. Are past 2 years up to about 10 years. And we really like that segment because these artists are still touring. They're out touring, acquiring new fans. They're releasing new music. And every time a new album is released, the baseline of the back catalog actually gets a pop in revenue and it resets. So when you bought it down here off of trailing 12-month revenue, that would say off of $100, they release a new album and that new baseline of trailing 12 months typically ticks back up. And so you can get some yield generation there.
Well, I'm glad I don't work for you, because if I was a portfolio manager of that stuff and my artist hadn't done anything, I'd get on the phone and say, look, start writing something. We need another thing. Now, Apple Music, that's my jam. I listen to it every day. I listen to the same freaking songs every day because I never get through my favorites, right? How does Amazon Music or Apple Music, et cetera, work in this play?
So those are the payers. So anytime these songs get played on Spotify, Apple, or Amazon Music, though they have to pay the owner of that intellectual property. And so the more streaming platforms, the better. Market share actually, as the industry is growing, Goldman Sachs projects 7 to 8% annualized growth through 2030. And 8 to 9% specifically for recorded music rights. So it's it's growing. These platforms are contributing to that, and we're grateful for the ecosystem.
It's great. So let's break this down a little bit, Toby. I'm just trying to get my arms around this. So you have a potential client, an investor, and they're tired of the uncertainty in the markets, what's going on with the economy, with the United States globally, et cetera, et cetera. They go to you and they say, Jillian, I'm going to write you a check for X amount of dollars. We're going to invest in music royalties. Do you then just focus on one catalog, or are you looking to diversify, or how does it work then from that perspective?
Yeah, at Pier, the name of the game over here is diversification. So we love to be invested in a handful of catalogs across many genres, across geographies. We do focus on US-based rights, but our preference is to create a diversified portfolio and ensure that we're not focused just on Latin music or just on rock music. And we like to have a diverse catalog age. So yeah, some 2-year-old tracks, 10-year-old, 5-year-old tracks, to ensure that there's diversification. So, today we put a bid in on a $200,000 catalog, for example. So very small. And actually on Friday, it looks like Friday's our close date on $1.5 million country catalog. The 200,000 is hip hop. The 1.5 million is country. So again, it's creating this large diversified portfolio that will withstand changes in music tastes over time, as well as just again various catalog ages and other things.
And do you you are the only owner? Pier is the only owner of these catalogs?
So when you buy a catalog, you can be buying the entire, it's called a master. So you could be the one you could be the only owner of the master of the whole song and buy it from everyone who owned it. That's a deal we could do. Or, for example, there could be a rock band that's well known and the guitarist owns a right to a part of the song. They died, they passed it on to their son, and we could buy just their part of a song. So the answer to your question is anything and everything for us, we could buy. There are other funds who are only focused on buying the master and they need the whole thing. And there are and that's because typically you would want that for something like a Bob Dylan catalog. So because if you have that master, you can go make a documentary. And then that documentary goes big and everyone starts
other derivative income from
Exactly. Whereas for us, we're not buying catalogs from artists that are that brand name, again, because you have to pay these crazy multiples, which actually it's a bad financial return. And so we focus on smaller catalogs where we're purely cash flow investors. And so, we're not going to go make a documentary off of a no-name artist because that won't provide lift to the cash flow anyway. So we don't care if we're getting the master or not, we will. Or we can just buy individual slices of things as well.
All right. So give us the numbers, young lady. I give you $1 million. You're doing the voodoo that you do on these smaller catalogs, et cetera, et cetera. How much am I earning per year? Basically.
So being under the purview of the SEC, we don't talk about target returns publicly. So I
Okay.
would love to share that and talk about prior returns and public returns, but being under the purview of the SEC, we can't.
Okay.
Well, can you answer it this way then? So if that $1 million from Toby goes to you to invest in these catalogs, are you providing an income stream back to Toby, or are you just focused on the appreciation of the catalog?
Yeah, so by investing in music catalogs, you would receive a distribution. You receive that cash flow out and back to you. So these are cash flowing assets. Typically, underlying music royalties pay quarterly, and so you would receive quarterly distributions by investing in this asset class.
Wow.
Okay.
Can I go to you and say, listen, here's who I want you to buy? I don't care whether
we love any and all suggestions of artists, and if you know any agents, if you know artists, reach out and send them our way. We love deal flow from anyone and everyone.
Yeah, we do.
I listen to soundtracks. I listen to movie soundtracks a lot while running and working out. And I'm wondering what
music.
Yeah, I mean,
that Garden State
music,
soundtrack to this day, Garden State soundtrack, love it.
Yeah, well, Enrico Morricone did the music for a number of movies, but he's got one about Wazoo Falls down in Argentina that I was at last year. Listening to the music, being at Wazoo Falls, and thinking about how many million people are listening to it right now at the same time because there was stuff going on, and it was like, that would be the coolest thing. That would just be the coolest thing to say. Yeah, I got a little Enrico Morricone in my portfolio.
Yeah, no doubt about that. So guys, let's close it out on this block. This is a fascinating discussion. I know the audience is going to get a lot out of this as well. And I know we'll have more questions about this, but we're going to break down a little bit more about Pier Asset Management, because music royalties is not their only game. They got a few other alternative ideas that you definitely want to hear about. So with us today is Jillian Murrish. She is the CEO of Pier Asset Management out of Los Angeles, California, and she's going to be with us right after the break. Please stay with us.
Buy, hold, sell, brought to you by CrossCheck Management.
Welcome back to Buy, Hold, Sell. Well, with us today is Jillian Murrish. She is the CEO of Pier Asset Management. We encourage the audience to check out our website at pieram.com. You'll learn all you need to do, all you need to know about, obviously, their alternative investment style. You definitely want to check it out. So we were just talking about music royalties, Jillian, in the last block. And that's a fascinating conversation. But you also look at specialty finance as well as litigation finance. Can you tell the audience a little bit about the litigation side?
Certainly. So litigation finance is a niche within specialty finance. And the reason we love it right now, as we talked about, these uncertain times make us flock to assets that just really aren't affected by unemployment, by a general recession. And so in litigation finance, what you can do is the verticals within litigation finance are numerous. I know nothing about some of them and a lot about certain ones. And it's, again, there are examples I can give to bring some more light to this. So for example, there could be a lender that goes and gives money to someone who did a slip and fall in a restaurant. There was a huge spill and the restaurant didn't let people know. It was very dangerous and someone fell and, shattered all their legs and arms. And so they're saying, okay, the business needs to pay me because that was very dangerous. They knew about the spill. They hadn't cleaned it up. And this person can't go to work anymore. They can't drive their car. And so while they're settling this case with the business, this person can't work. And so they go to this funder, and this litigation funder says, hey, we'll give you $10,000 today. And when your case settles, you'll pay us some money for giving you that advance. And then you get the rest of the big settlement. And so that's an area where, again, the court system is working through that settlement. And again, it doesn't matter if unemployment is high or low, that case is going to get tried, it's likely going to get settled before it gets tried. And it will go through, and the litigation funding firm will make money for fronting that capital.
And they have a lien against the total package?
Correct. Yeah, what's going to come out of the settlement.
So when the cash goes into the escrow account, for lack of a better word, to pay out, you guys are on top of that stack?
Yeah, so it's an IOTA account that's used, the escrow account. And that, yes, so the funder would get paid first, and then the rest of the proceeds would get split through the waterfall to pay for medical bills and to give that individual, the plaintiff who slipped and fell, the rest of the capital for that damage that they went through. There's other sectors that I find more interesting than the classic slip and fall. So,
you mean than being an ambulance chaser? Is that what you're trying to say?
yeah, there's other sectors I find more interesting. So one of which is actually patent infringement. You are going to love this.
Yeah.
So being in the tech space, you're going to love this. So imagine there's a small tech company. They created a patent, they commercialized this new technology, and they went to say, you know, I don't know, a Google or an Apple, and said,
Microsoft, they steal everything, trust me.
Yeah, let's have a joint venture and we're going to work on something. So they work on something with them for 6 months, and then the deal falls apart. And a year later, their technology shows up in a product at one of the tech giants. And this small tech company has, you know, has a small budget. It's a small business. For them to go sue and spend the on average $8 to $10 million in legal fees it would cost to try that case and get what's rightfully theirs. This invention they worked blood, sweat, and tears on. They used all their ingenuity on. To go fund that is not possible as a small business. And so there's these litigation finance firms that come in and will fund those legal fees on behalf of these small patent infringed tech companies and fund the legal fees against the big tech giants. And when they win in a settlement, because usually these cases settle before they go to trial. So 95% of them settle because the big public companies don't want their name in the news, especially don't want their name in the news as a David Goliath situation, like they're doing something bad to the little guy. So 95% of these are settled before they go to trial. And so you're really on a 2 to 3 year clock for getting capital paid back as a litigation funder in this instance. So a litigation funder comes in, pays all the legal bills for the small tech company, and when the $100 to $150 million settlement comes in, the litigation funding firm gets their $10 million back. They make a great return, and then the small business gets paid the remaining of those damages. And so it's a great ecosystem because it keeps big business in check. It preserves the ingenuity of U.S. inventions and that the whole ecosystem that makes this country great. And then third, it's a great financial return for those who invest in litigation finance. So it's a win-win-win all around.
So hold on, you're investing in in this case, you're looking at providing the I guess the financing to
the legal bills,
the litigation financing company.
So for us, as Pier Asset Management, we typically lend to lenders or we invest in a lender that goes and makes those loans. So we're working with a litigation funding firm who goes and actually says, hey, we're going to give $8 million to this law firm who's going to try this case on behalf of this small business. When they win, they're going to take some of the money, but the vast majority ends up going to the patent owner. But for funding that case along the way, they get paid a great IRR for doing so.
Yeah, and you own, I mean, this is, you're securitized, you have security interest in this that's filed. So you're going to get paid when they get paid literally, at the same time, correct?
So generally, again, the way this works is an IOTA account is used at the law firm that's doing like case oversight, it's called. So usually there's a third party law firm that comes in to oversee how are these case proceeds getting paid out. It's actually very similar to mass tort, which is a whole nother segment of this. So like like the big fire cases that are going on in California, the Maui fire that got a lot of publicity, those mass tort cases, when the big capital comes in to settle those cases from the utility companies, a law firm sits there and then divvies it up between all the participants who are owed their piece. And so, yes, in the instance of patent infringement, which we're invested in, we sit in that waterfall and get paid out by the law firm.
Scott, Todd, only in America could you have a multi-billion-dollar industry of financing lawsuits,
right?
From billboards on the side of the freeway, only in America.
I never even knew it existed. This is incredible.
You know what's wild, Toby? You know what's wild and so surprising? Litigation finance and the funding of cases, this model actually came from Europe. So the US investors ripped it off from Europe, which is like shocking to me. When I learned that, I couldn't believe it. I haven't fact checked it, but I've heard it in a few places, so I think it has to be accurate. But I just thought it had to be an American invention, but no, I think it came from Europe.
That's incredible.
Oh my gosh.
So what's the time frame though for something like that? I imagine it takes years then, right? I mean, if you're you're providing the financing to get that return for Pier Asset Management, it could be a several year investment.
Yeah, so various segments within litigation finance have different duration. So actually these slip and fall cases, in that segment, it's called pre-settlement. Typically those are, 2 to 4 year cases, and you can actually get some cash back as early as 12 months. The reason I really like the patent litigation segment where they're doing patent infringement is that those cases generally all settle before they go to trial. And trial dates are typically set about 24 months after the case is filed. So in that instance, you're actually getting early settlements in at 18 months, 24 months. And so cash flow comes very early. Something like mass tort can have duration up to 10 years. And so investing in mass tort is really a long duration type investment, which is, harder for us to get involved in because we are focused on short duration investment opportunities.
Yeah. Wow.
So this is super specialized. So your firm is looking at areas. I mean, I'm sure I'm not alone here. People watching this show right now are thinking they never knew this type of business even existed. But where did you come up with these ideas? I mean, was this yours? I mean, did you have experience with this in a past career?
Yeah, so my business partner Connor and I co-founded Pier Asset Management in 2017. Both of us had been in the specialty finance industry before. My partner was an investor at a large firm doing consumer and small business investing out of one of their vehicles. I was actually on the operator side. I had built and ran the capital markets practice at an online real estate originator. And so I was the baker baking the bread, like making these specialty finance assets that Wall Street was consuming. And I sat there and I said, hey, there are a lot of participants buying $50 million, $100 million, $200 million pools of specialty finance assets. There's large, all the names that we know, the Apollos, Adelayas, Ares of the world. And there really weren't very many investors investing in sub $25 million portfolios of these assets. And I saw, family office here, an institution here do it. And they were making, mid-teens, 20% yields by playing in a space where not others were investing. Whereas the big firms were all competing against each other, driving yields down. And so I said, hey, there's an opportunity to go invest in these niche asset classes that aren't heavily trafficked, and we can make outsized returns by doing so.
Yeah, and the private equities raise so much money, they have so much under management, and they have to do, $1 billion deals to move the needle, shall we say. I haven't used that term in a long time. And so, this is a wonderful part of capitalism. You found this niche, you developed expertise, you went out and begged for money like we all do when we raise a fund or one or two, and you got returns, and then there's the positive feedback loop. Somebody goes from the company that gave you the money, they go someplace else. You say, have you done this before? Blah, blah, blah. So I'm well done.
Yeah.
Thank you. And building that deal flow flywheel. So like running an investment management firm, like where is your equity as a business? And for me, I say it's access to high quality deal flow consistently year after year, season after season, and cycle after cycle. So each type of environment, are you generating deals that provide a risk-adjusted return that's attractive through cycles? And so, for us at Pier, it's been 8 years, and a lot of what we invest in are these short duration, 12-month or less transactions. And so, as you said, like building that deal flow flywheel is all word of mouth for us. So it's, hey, I got a credit facility from Pier. I'm an equipment lender, and Pier gave me a credit facility. It worked out fantastic. I scaled my business and refinanced with a $100 million facility. Call Pier for that small $25 million facility. Hey, I'm a producer. I owned my music catalog. I sold it to Pier. It went great. He goes and tells his friends.
Yeah.
And so it's a lot of word of mouth. Being this boutique size manager, we get to do interesting deals, and our reputation is everything. So, really trying to do right by those counterparts is number one for us.
Yeah. So Todd, by the way, in your sort of messed up language back there in Buffalo, she works for Pier, Pier, not Pure. Okay.
Okay. Pier A.
There you go. Now you're talking.
Jillian, final question for you. So if an investor goes to you and they have X amount that they want to participate
Allocate
in one
to
of these
your
deals,
fund. Yes.
are you then sitting down with them and saying, well, we're going to diversify going into music royalties, the patent infringement side, the litigation financing, or is it just one area and that's it? Or are you trying to give the whole ball of wax here?
Yeah, so at our firm, we invest in all of these strategies, and clients who come to us can be interested in just one or interested in a diversified portfolio or way to get exposure in a diversified way. So the answer is any and all of the above.
Hey, so
Okay.
if I have a LLC or an LL or limited partnership, I do these special purpose vehicles for various things. If I have a special purpose vehicle over, let's say, $1 million, 2 million, 5 million, can I come to you and look to make a deal where we can be an investor in your stuff?
We are accepting new clients at Pier, so we're interested to talk to anyone who has
Cool.
capital.
Yeah, and these are all accredited investors. Typically, we do 3 to 5 million. I love the income side of it, though. So often, because there's sort of delayed gratification on some of these things, and there's something like, geez, I get a check every quarter. I like that.
Yeah, being a cash flow investor is the heart of what we do at Pier, and that's who we are, cash flow investors.
That's amazing. I love it. Well, I know the audience loves it too. So Jillian, we got it. We're going to close it out right there. I know you're going to be coming back to for a part 2 of this, of talking all about Pier, because you're going to be on Money Mavericks in 2 weeks for a one-on-one with Toby. I know he's going to have a lot of good follow-up questions for you regarding the business. So it should.
Obviously, the host is, my show's a little better looking. I mean, basically, and humble.
There
Well,
I
can't wait.
Absolutely, absolutely. So Jillian, thanks again for joining us. We can't wait to have you back on this show. I know you'll be on Money Mavericks, and but we definitely this was so much fun, and I know everybody
And
got a lot.
Jillian, he says that to everybody, but he actually means it with you. Okay.
No doubt. No
Well,
doubt
this was a
about that.
blast. Thank you.
That's great. That's great. Well, I'm glad you enjoyed it. I know the audience enjoyed it as well. And you definitely want to catch what's coming up on all of the Biz Talk Today shows coming up. We have Danny Riley. He's a big Chicago trader. He's going to be on Wealthwise with Jeffrey Hirsch this Friday. And next Friday, Anthony Scaramucci is going to be joining us. Boy, is that going to be big time show for BTT. So you definitely want to check in and see what Anthony has to say, and he has a lot to say, that's for sure. So on behalf of Jillian Murrish and Tobin Smith, I am Todd Schoenberger. Thank you once again for joining us on Buy, Hold, Sell. We'll catch you next time. Take care.
Buy, hold, sell, brought to you by CrossCheck Management.